Good afternoon, everyone. Thank you for joining for the second panel session of this ESCoE Conference on Frontiers in Nowcasting. I'm Stuart McIntyre from the University of Strathclyde and also part of ESCoE and the ESCoE Leadership Executive. This session, where we've got three terrific speakers, is focused around nowcasting. And nowcasting has long played an important role in economic policy making, and I would argue now more than ever there's been a real emphasis on the importance of nowcasting across government and beyond. Policymakers, analysts, the public increasingly want real-time insights into what's happening in the economy, helping them understand developments in the economy, at the same time as official statistics continue to be released with a lag. They're revised, sometimes there are significant gaps. And of course, we've seen over the last few years internationally challenges around the quality of survey-based economic statistics. And so I think for policymakers, central banks, statistical agencies, all of this feeds into a set of challenges that we'll talk about today. How do we provide timely insights when lots of our statistical infrastructure was not designed to support real-time decision-making? How do we best make use of the volume of data we now have available to us, in particular the granularity of the data? We'll touch on later on in this session the availability of individual and firm-level data. How do we make best use of that? Michael, in his talk earlier, touched a bit on this as well. And how do we communicate model-based statistics alongside survey-based statistics? And I think that's something that statistical agencies in particular are struggling with. Very experienced in presenting survey-based statistics, less so model-based statistics. I think the good news is that the toolkit available, as we'll hear through this session, is increasing in its richness, addressing a lot of the emerging data opportunities and computational challenges. And as I said before, policymaking and the private sector are increasingly using these tools of nowcasting. So today's panel brings together three speakers working right at the frontier of many of these issues, and we'll hear a bit today about some of the work that they're doing in this area. So we'll begin with Giulia Mantoan from the Bank of England, who will discuss nowcasting in settings where official data is missing or unreliable, drawing on some UK applications. We'll then hand over to Michele Lenza from the European Central Bank, who will talk about the ECB's experience with GDP and inflation nowcasting, and talk about new data sources and how those methods are reshaping institutional practice in the ECB. And then finally, we'll hear from Raffaella Giacomini from University College London, who will take us into the bold new world of micro-forecasting and talk about the challenge of predicting individual behaviour and what recent advances, including large language models, can and can't do to help us. So in all, I think these talks will span that practical, the institutional and the methodological dimensions of nowcasting. Each of the speakers will present for about 10 minutes. We will then take questions to the speakers together at the end. So if you have questions as we're going through the presentations, then please keep them till the end and we will take them all together. Okay. And with that, let me hand over to Giulia to kick things off.
Amazing, thank you. First of all, thank you very much for everyone to attend this session and for the organizer for inviting me to this amazing panel. So it's also very nice to be in this conference always, I have to say, because it's a great opportunity to talk about measurement and the issues around measurement of economic data. And today, this is exactly what I'm going to talk about. So my topic is about how we can nowcast in an environment in which measurement is actually uncertain. So before starting, since I work at the Bank of England, let me just disclaim that these are my view and not the one of my employees or of the Bank of England or its committees. So if I go to the next slide, I just want to talk a little bit about the data environment that we are working on. Should I just click? All right. It's okay, it's okay. And I'm very worried of touching something and then... Should we just start? Oh, there you go. Thank you. So, amazing. Thank you. So, let me just see if it works. OK, perfect. So, what I wanted to say here is that maybe you're not aware of, but I think many in the audience know, that the landscape of data is becoming noisier and noisier, especially in recent years. So, the LFS, which is the UK primary window into the labor market, has been under a lot of scrutiny in 2023. And the data lost credibility. So we had many conversations about this in the previous years, also in this conference. I know that many of the people here are involved in these reports and in the new LFS, so I don't want to talk a lot about this, but I just want to say that these issues are becoming more and more important also in other countries. So in the US, more recently, government shutdowns have caused the employment reports simply to not be published. Okay, so more reports, also at the international level, have been writing about how the risks to economic statistics are becoming wider and broader in an international setting. So this regards different statistical offices, not just the UK. And the point is that data is becoming harder to trust, harder to interpret, and sometimes just missing. So how are we going to do nowcasting in this environment? So what does it mean for nowcasting? So what I think is happening here is that traditionally the nowcast process and the nowcast topic was to just deal with the timing, right? So we knew that the data was correct, but it was just low or it was revised. So we know very well how to deal with this. This is just a signal extraction. I can use other predictors that are available before the official statistic is released. And I can just do one of the many models, whatever is my favorite, whatever is the best out of sample. It can be a bridge model, MIDAS model, DFM. And this is what central banks and other policymakers and in academia we've been building models and writing papers on this. And we know how to deal with revisions, right? We just have to do a real-time analysis. What we find more and more are like new issues with nowcasting is that the data now may just be missing or subject to great uncertainty. So the problem with the LFS that we had, LFS kept being published, but we didn't know, actually we knew that the people surveyed were too small, so it was not representative anymore. So how are we gonna do nowcasting of this data? Should we just focus about the underlying trend? Should we focus about nowcasting the data point? So now you can see that now the topic is kind of changed. We have to be flexible to data issues, to volatility in the data set, and think about underlying patterns. So what I noticed is that nowcasting is no longer just a timing problems that we have to solve, but it is increasingly a way to handle measurement uncertainty. So great. So how can we do? How do we do to build model with this? So what can we do about this? So here today, I want to highlight two pieces of work that I've been working on that may kind of answer this challenge. So the first is about flexibility. So we need to have models that are way more flexible, that can build models that work even where the data pipeline is broken or disrupted. And second is about transparency. When we are uncertain about data, why should we even report a single number? Why should we even think about nowcasting these releases? So let me take each one in turn. So the first one is a paper called Nowcasting Using Regressional Signatures with many co-authors. And this was actually work that I've done in, when I was in my postdoc at the Alan Turing Institute in collaboration with ONS, with some people also in the audience. And what we built here was to actually look at what I mean. So what you see here is basically what the data environment is actually when we are trying to do nowcasting. So first of all, you can see the official release in here. So this is unemployment, LFS unemployment. So we say that the data is released for each month. It released 45 days after the end of the month. But this is actually just something that us as nowcaster we decide is true. In reality, we have volatility around when the data is released. The same for surveys, and then basically what I'm trying to do here, I'm trying to nowcast this data using weekly experimental data and surveys, okay? And you can see that the Google Trend is released always at the end of the month because it's just Google Trend. If the end of the month it comes on Sunday, it doesn't matter, okay? So how do we do this? So we use path signatures. So I'm not going to go into details, but there are links in this presentation if you want to read the papers. So path signatures are just mathematical objects that capture the full geometry of time series path. What does it mean is that if I don't think about misfrequency or missing data point anymore, and I just order the data, I can use a continuous time Kalman filter, sort of, to actually infer my nowcasting. And what you see here is how it worked for October 2021. So this is basically just a month after the end of the furlough scheme in the UK. And this was a crucial problem, like a crucial moment to do nowcasting of unemployment because the furlough scheme was great, obviously, but it kind of broke the relationship between activity and labor market. So it was very hard to know what was the state of the labor market after the scheme was released. So I was ended. So here you can see all the data that I'm using that I saw you before. Every data point, color point is basically one release. And you can see that basically my signature model actually gets the nowcast right. So while the other models are still struggling. And this is true over the whole out-of-sample period. So this is not just a lucky draw. So just trust me. And there are more details in my paper. If you're interested, I'm also happy to chat more about this. The second solution I want to talk here is about transparency, is about actually going beyond point nowcast. And this is something that in the literature of forecasting and nowcasting we've been talking about for a while. Here you see basically a quantile models, which is just density forecasting of the model that we use at the bank. And here you can see that here I'm allowing to be multimodal. And then what I want to show you is basically March 25 and June 25. You can see that now the distribution for GDP nowcasting becomes bimodal, okay? And why is it bimodal? It's not because of the problem of the model. It's because the different data sets were pointing in different directions. So this was actually a great tool, I think, very modestly, to engage with the policymakers and actually talk about whether they believe more the data that point towards this mode or the other mode, right? So all of this uncertainty about data and model is kind of, concealed when we actually talk about point nowcast only. So this I work with my colleague, Jessica Verlander, and this is a bank overground, but there will be a paper out soon. So let me just conclude. So today I wanted just to talk about how to deal with measurement problems where we do nowcasting, and that we actually have to build models that allow for these problems to be embedded. So there to be more flexible models handling missing data and non-linearities, or maybe when measurement is uncertain, maybe we should just quantify the uncertainty instead of thinking about the point accuracy. And then I have a couple of questions, because this for me are still a point that I don't know how to answer yet. One is how to evaluate nowcasting models when we don't really believe on the data that we see in that specific point. And then actually what should policymakers care about in this environment? Okay, this is it. I had another slide, but maybe not. So just thank you, and you see the links if you want to know more. Thank you.
yes. Okay, so thank you again as well on my side for inviting me to this conference. Unfortunately, I couldn't attend yesterday, but this morning I managed to follow all the sessions. It was great. So today, what I want to talk about a little bit is how do we do nowcasting at the ECB, but I bet that actually there is a lot of similarities. So now nowcasting is actually done in many other central banks. And I should start with the disclaimer as Giulia. So these are my views and not those of the European Central Bank, the Eurosystem, and the CPR. So what I'm gonna try to talk about today is effectively three things. First of all, why and how we nowcast. Then I will give you two examples with the two core variables that we nowcast at the ECB, which is GDP and inflation. And I will talk a little bit about the way ahead along a similar dimension that Giulia mentioned before. Every time I'm going to do this type of presentations and I talk about why we nowcast, it always comes to my mind the most powerful test I have in mind of economic relevance, which is what I call the nonna test. Like I picture myself in front of my grandmother, and she asking me, Michele, what are you doing these days? And I tell her, Nonna, I'm predicting today, I'm predicting the present and the past. And she looking at me quite wide-eyed, saying, okay, maybe we didn't spend so wisely the money on your education. But let me see if I manage to convince you why we do nowcasting and why this is important. Of course, nowcasting and actually short-term forecasting, which is a strict relative of it, is about asking what is the state of the economy now and in the near future. Whether it is nowcasting or short-term forecasting really depends on the timeliness of the release of the variable we're talking about. For example, GDP is a quarterly variable, is released only 2 months after the end of the quarter, so there we nowcast. Inflation in the euro area is a monthly variable released just a day after the month is over, so nowcasting is not so relevant, it's more short-term forecasting. So looking a little bit ahead. Why do we do that? Well, data on the current state of the economy may not be available or may only be imperfect proxies of the data we would like to have, for example, some type of soft information. And why in a medium-term oriented central bank is important to know where we are now? I think there are mostly three reasons. First of all, if you do forecasting, you know that it's very important to start with the right foot. So having a good starting point for the medium and long-term forecasts, which are arguably more policy relevant, is very important also to reduce the uncertainty on those forecasts. It is also important, given that normally for nowcasting and short-term forecasting, we have much more flexible toolboxes that you can run in a very short amount of time. It is important to have these toolboxes to see, for example, during a quarter in which we do not have every month or every week a new macroeconomic projection, how are we doing? So there are new data, how are we doing with that projection? Is that one still relevant? So in a sense, to cross-check continuously the view that we have on the economic outlook. And then there is a no-stated purpose, which I think, on the other hand, is a very important function in nowcasting. Because of this agility of the toolbox and the willingness to remain state-of-the-art, that's also the initial point where innovation in macroeconometric modeling comes into a central bank. How do we nowcast? Well, the key aspect is to integrate as much as possible high-frequency and timely information. So the typical element that we have in a nowcasting toolbox are, first of all, a search and selection of relevant information. Again, as much frequent and as much timely information. So, for example, one of the key aspects of the nowcasting literature is the lesson that sometime we look at information that is very imprecise simply because it comes very early and still gives a signal compared to more precise information which comes later. Typically, we need to find a solution for the problem of dealing with mixed frequency, ragged edge, and generally missing data. And Giulia was talking about some of those solutions. And then all the econometric model that we use need to be also able to produce a narrative. So, for example, if I go to the board members of the ECB and I change my nowcast, they want to know why. Then I have to tell them why did I change my forecast. So let me give you a couple of examples for GDP and inflation. So there actually has been a recent review and change into the modeling, the nowcasting modeling toolbox for GDP in the euro area. You can see there a link to an article. So what do we do now is basically to use just a static equation between GDP and a bunch of value-added variables. And then what do we do is to forecast GDP effectively is to forecast those value-added variables that are three, so value-added in services, in construction, and in the industry, by using much more sophisticated macroeconometric models. So what we do is we forecast those variables, and then via this static relationship, we forecast GDP. And here you can see an example of for the third quarter of 2025. So these are the different vintages of the prediction for that quarter. So when more inflation was coming in, we were changing our view. And here you also see what I was mentioning, that you need to have a narrative for those changes. So basically these bars are the effect the different data releases we're having on our forecast. So we were telling the board, look, now we think that the GDP is growing at 0.3 rather than 0.28 because of the releases of these variables. And this is done by using state space techniques. By the way, this is a point forecast, but actually we produce a density forecast for the reasons that Giulia mentioned before. For inflation, it's short-term forecasting. We project up to 12 months ahead, and typically we project the individual components of the headline basket. For example, the core toolbox includes services, non-energy industrial good, energy, process and unprocessed food. So these are forecasted individually in Arimax equations, so basically an equation where you have the lags of the variable, but also a set of predictors. And these predictors are the standard predictor you would have in mind, but also some that are a little bit more unusual. For example, we have the so-called weekly oil bulletin. So that's the price of fuel at the pump, and it's weekly, so it's very high frequency and very helpful to produce forecasts of energy, and web scrape data, for example, for food and services. And all of this this toolbox can also be cross-checked by much more complicated models, and also able to produce density forecast. Here, one example of cross-checking of the short-term inflation forecast or the projections with the new models. So these are with the machine learning model. So this is taken from a speech by our chief economist, Philip Lane. So you see here, these are the yellows are the inflation projections, the quarterly inflation projections. And these were a little bit stale at the time of this speech, in the sense that they had been produced a few months before. Then here, in this area, you see the density forecast from a machine learning model called quantile regression forest. You see that at that time, that forecast was putting a lot of the mass under the yellow. So basically, this was telling us in real time that maybe we should revise this forecast down, because a lot of the information released after the projection was actually pointing downward. So in jargon, we were saying that there are downside risks. So what's the way ahead? So what we are doing in terms of evolution of the nowcasting toolbox, the first thing is that the analysis is becoming increasingly granular in terms of the targets, so disaggregating inflation even more, for example, but also in terms of the determinants. For example, in the past, we were only tracking the global price of oil because that was enough to capture energy commodity prices. But now there has been a strong decoupling between gas and oil prices at the global level. So we track also gas prices and the gas market. We nowcast or short-term forecast more variables because of the current events that tell us that there are many more things that are important to monitor. For example, we have new nowcasting toolboxes for trade variable, fiscal variable, labor markets. We have more emphasis on capturing complex pattern in the data, so we're using more and more machine learning models. And then, of course, we are using more and more new data sources, including satellite data, for example, to capture supply chain bottlenecks or oil demand, text data like those that Michael was discussing this morning, and a few others. Let me stop here.
Thanks, Michele.
Okay, so while we get the slides, I want to advertise very quickly something that is competing with what Giulia and Michele were talking about, which is at the UCL, we're going to launch on the 5th of June our very own nowcasting of the UK economy. So we'll be providing this real-time nowcast of inflation and GDP, which are competitive with the Bank of England, much more high frequency. So if you're interested in the launch event, there's going to be champagne, send me an email. There's still some slots open, but I won't talk about that because they already said essentially what we're going to do the same, using the same tools that they talked about, but for the UK economy. So I'm very glad to be here, but I'm going to be talking about something else, a bit from a more academic perspective, which is based on my own research, which is really going into this forecasting, not aggregates like inflation or GDP, but individual behavior. And individual could be a firm, could be an actual person, could be a component of inflation, could be a country, a state, disaggregated forecasting. And then I'll be talking about really, micro forecasting is only as good as what you want to do with it. So what do you care about? Why are you doing micro forecasting? So the motivation is the following. So there are many policy questions that increasingly rely on the ability to forecast individuals. So for example, you can think about understanding who are the more financially vulnerable households, the banks that are facing potential distress or failure. And so the question is, do you really care about an aggregate sort of systemic problem? So on average, who's going to fail? Or do you care about identifying who are the banks that are going to fail? So these two really call for different statistical procedures, okay? So you might be thinking about, do I care about the average or do I care about outliers, broadly speaking? And I'll talk about these two different objectives. So on one hand, if we are from the policy perspective, one useful field where it might be, this may be relevant is a policy evaluation when a policy is universal. So if we don't have the usual untreated group that we could compare our treated with. And so that is, broadly speaking, a problem of forecasting counterfactuals. What would have happened to that person in the absence of the policy? So that's where some of the forecasting methods can become handy. But because there the policy objective is an average, then it's a different, our goal ultimately is trying to get an accurate average. On the other hand, if you want to understand, who's going to fail or who will be unemployed, or you want to identify high performance in a bank or in a school, then perhaps you just want to get it right for identifying really the outliers. So that's it's more about a problem of robust individual predictions. So from the first perspective, we have a paper that is about this universal policy evaluation. And so the basic idea is think about a tax reform that affects everybody. You go back into using potentially very short time series before the treatment. And so this is really fundamentally important to not rely on the assumption that we have a very long history for everybody. We might have a very patchy and short history. So how do we do counterfactual prediction? And so it turns out that you can actually focus on this even very short history to predict for each individual what would have been their outcome in the absence of a treatment. And so it turns out that for that, the basic punchline is that it doesn't really matter that you get it right for every individual because you only care about the average, and the individual noise, which is a fundamental problem in this data, averages out. Okay? So you can assume that on average, you're going to get it right. So really what you have to care about is the counterfactual aggregate path. And then you can compute the average treatment effect with that. So visually, so the problem is fundamentally individual histories are very noisy, particularly if they're short. People come in and out of employment. There could be measurement error in the data, which you know about better than I do. But the point is that if we only care about the average, the black line, then that's quite stable. And so we can hope that this noise, but that's a big assumption, averages out. On the other hand, if you want to actually identify, if you want to take, the individual in the bottom is a fairly stable path over time versus some of the other lines, there's a lot of volatility. Okay, so these two individuals require perhaps a different treatment. And so for microforecasting, if you really care about those individuals, in this recent strand of my research, I look at using these very noisy individual histories to predict individual behaviors, and particularly for outliers. And so the fundamental, a very long-standing approach of doing this is to use some way to borrow from the majority. So the idea is that your own individual past data is very noisy, so I'm trying to shrink your estimator based on your own past data towards some aggregate, some average. And this goes back to James Stein to the 60s, which is the shrinkage estimators, or a Bayesian empirical Bayes estimator. So this is what we do to reduce the noise. On the other hand, so really only slide, I promise, with some math, is what is a shrinkage? So we have two sources of information for each person. Potentially is their own path. Maybe we have a few handful of data points for each person. But then we also have a lot of observable characteristics that we can use to predict what that person, given their characteristics, would do. So that's your pooled or borrowing from the majority forecast. And the idea is just to take a simple weighted average. Now, what's important is how do you pick these weights? And so that's a central problem, is are these weights going to be the same or different for every person? And that depends, okay? So if the majority is the left black dot, each person, someone who's very much of an outlier would require perhaps much more shrinkage to be closer to the middle, but should that person really be shrunk that much towards the middle? It kind of depends how much your observable information is important for predicting your behavior versus your past behavior. And so the tension is really how to choose the shrinkage in a way that is data-driven and adaptive. Okay, so then the fundamental problem is what is known as already in the literature as the tyranny of the majority. So the idea that you maybe not want to shrink outliers that much. If people are fairly homogeneous, they benefit from borrowing from the majority because that reduces the noise. If I'm truly an outlier, maybe I shouldn't really, my decision shouldn't be based on my observable characteristics, but maybe looking at how I behaved over time. And so this is particularly important if you care about these tails, which typically we do. And so we have this one slide from the paper is that, negative is bad. So there are methods that are optimized, like these existing shrinkage methods are optimized for average. Getting it right on average are not good for getting it right for individual persons, particularly for outliers. So you have very large errors for the outliers, whereas if you're kind of an average Joe, you would benefit from the typical shrinkage. Okay, so then what is fundamentally, the fundamental tension here is with observables, your age, your gender, your race, and these characteristics tend to help explain averages, whereas your individual histories are more informative for your outlier, tail predictions. And so the tension is between also observables versus unobservables. And we want to perhaps try to use modern methods to identify histories that reveal your unobservable sort of persistent heterogeneity. That's how we talk about it. That, predicting your behavior based on the fact that you're an Italian woman maybe misses a lot of individual heterogeneity. So finally, the idea is that using this adaptive pooling, and I talked about machine learning. I didn't want to talk about machine learning and large language models because that's ongoing research, so I don't have pictures or results yet. But it's fundamentally, we're trying to ask ourselves, where are these large language models coming in? What would they help us with? And we're thinking that perhaps they'll help us identify the average person. So, now these are based on very simple averages. But maybe we can use machine learning, which are much more sophisticated predictors of what aggregates will behave like. And so we're thinking of using machine learning to understand what the average person would do, and then maybe they will help us better identify the outliers. And that's where we're going. So we're thinking about richer, observables information that is coming from the new sources of data, text, unstructured data, LLMs, based representations, to really pin down the average Joe behavior, and then use your individual history to pin down your unobservable heterogeneity. So that's take-home lessons. I'm very happy to take more questions.
Thank you, Raffaella, for that, and Michele and Giulia as well. We have about 20 minutes or so for questions, I think. There are some microphones which will be brought to you. Maybe just to give you a minute to think of any questions you have, maybe if I pick up on the question that Giulia had in her slide deck, which was whether the future of nowcasting is about better statistical methods or better measurement infrastructure. I'm getting a sense you might say statistical methods. Raffaella?
No, definitely. It's a combination of the two. So first of all, the reality of new data needs to be taken into consideration, which is the noisiness. Whether there's also a trade-off. Some data may just be noise. So do you want to use that noise versus the signal? So fundamental techniques of signal extraction are going to become important as well. So maybe they will differ when it comes to the new nature. I think Giulia's paper is kind of going into that direction. Maybe treating this noisy data as a structure by itself. I think that's a very interesting new approach.
Yeah. You agree?
Yeah, I just think that you really need to know. I think like at the bank, this is what we build a lot of capital on, is to know how the data is put together. And we have all these very smart people on me, that I go to and ask what happened in 2002 with this particular data. So I think they really need to go together. It's very different to do nowcasting, I have to say, in papers and in aggregate level and in practice as well. So I think they still have to talk to each other. Yeah, this is.
Michele?
I can only agree with that. Actually, if I may say one thing that I forgot to say before, but relates to this. Actually, a new challenge that we have, because we are looking at new models, completely new model infrastructure, a lot of machine learning. One problem that we have is that, of course, these models do not lend themselves so easily to, state space and standard ways of, coming up with the missing data and so on. And actually, a new type of research that we need. It's how would you replace the standard state space in the linear setup for this type of models? What would be the equivalent, for example, to run a conditional forecast with a completely general nonlinear model for which other techniques may fail?
Okay. So let's open things up. Can I get a sense of questions in the room? Not being shy. I've got a couple down here. Maybe we'll start down here. And we'll take these first two and then we'll open it up to the other side. Give the second to the microphone. Yep.
Thank you very much. My name is Francesco Giacomini. I'm from the UK Department of Environment. I have a bit of a philosophical question. Essentially, with nowcasting, you're trying to kind of predict a moving object, in the sense that you're trying to predict something that's going to happen. But the moment you give this information out, this object already moved, so you create a lot of expectations. Is there a way to deal with that? Thank you.
And could you pass the microphone to the gentleman behind you?
Yeah, I feel a little bit out of place asking this with Jonathan next to me, but given that central banks really are interested in a counterfactual of what's going to happen to inflation and output if we do this to the rates today or tomorrow, and you're using these prediction models that are purely based on history of time series, here's the Lucas critique. I mean, how do you deal with the nowcasting and the Lucas critique?
Great. Mm-hmm. So I don't know who wants to kick things off. Michele, you look like you were.
So let me say something about this counterfactual. So generally, exactly because of the super short horizon, typically he wouldn't be so concerned until Stefan came actually with a paper that shows that monetary policy acts already in the first days after the change. So I think it's partly so. There is no. I mean, one thing that I can tell you, which I guess it's a bit the fact. So we know that nowcasting works extremely well, so much better than anything else. So this must not be a large concern. Why this is not a large concern? Either because maybe this effect of monetary policy is not so large, at least at those horizons, or because we are actually capturing it with the predictors. So I don't exactly know, but I can tell you that nowcasting is actually extremely accurate. So it shouldn't be too much of an issue.
Giulia?
Something to that, yeah. I think I've been thinking a lot about this and about scenarios and how nowcasting can actually help with scenario setting. And the way that I'm thinking more and more about this, just because exactly we know that it works and we know that it's very accurate, is that we can actually use it to think about which counterfactual is more likely. So if the nowcast is the most likely path, how likely is the second counterfactual, that we can think of, or another scenario, and so on. So this is the way that I'm actually thinking about bridging between nowcasting and counterfactual.
Raffaella?
Can I say something about the Lucas critique? So that really fundamentally goes at the heart of the tension that academics are really aware of, which is forecasting is one problem, policy evaluation, causality is an entirely different problem. So my research has started from forecasting, is veered much more towards policy evaluation. And when I was at the Chicago Fed until 2 years ago, it was definitely two different set of problems. So because a model that fits well is not necessarily the model you want for policy counterfactuals in the sense of understanding the true causal impact. I find the causal impact something that really, as economic academics, really that's what we're mostly focusing on and racking our brains with.
Great. Other questions from the room? The lady right at the back. Anything over here? It should be on.
Hi, so Shomili Basu from the ONS. My question is that, do you have any indication of how reliable nowcasting is in the face of any external shock?
Well, nowcasting is only as good as your predictors. This is something that we all know very well. So as long as you have good timely predictor for shocks, then your nowcasting model should be able to pick that up. If not, I think there is always room for judgment. So this is something that I do a lot with my quantile MIDAS model, which is based on quantile combination. So I will just, me or the analyst or the economist, we know that this shock is happening. We know that this variable is capturing well oil shocks, for example, or supply chain shocks. So we're just going to weight more the nowcasting that comes for that variable. So I think there's a lot of room for judgment. This is the solution that I found so far. Maybe you guys have a better idea.
So actually, that is handled a little bit differently at the ECB. So normally these nowcasting models are no judgment, completely no judgment, so they're entirely mechanical. But that's one of the reasons why they are obsessively assessed continuously, whether they are tracking well the economy or not. In fact, in my slides, I had this table where I was showing you already 2 different vintages of models, and the change had been implemented exactly because our colleagues started to see that with the shocks that were happening recently, some of the equations that before were working weren't working anymore, so they were updating the equations to try to make them work better. So there are changes in models, new information taken in exactly, because the nature of new shocks shows that capturing different information is more important. For example, the satellite data on supply bottlenecks have been introduced because we realized that these shocks can be very relevant. So I think that there is not just one nowcast. So basically, these toolboxes, in particular, if you use them without judgment, they need to be updated and monitored as well continuously.
Yeah, so I can say also, I think that's a fundamental question. Our models are only as good as their parameters are stable. But so one thing that is helpful, for example, at the UCL macro monitor, what we're doing is trying to disentangle temporary from permanent components of inflation. And so there are some statistical tools that, again, can tell you whether you observe a big change, is that temporary, or is that noise, or is this something that we should react to? And so I think it's very important to be able to say something about this. And also the disaggregate approach I was mentioning, we applied that when I was at the Fed. And there it was important because you could see that, for example, during that high surge, the 2022 in inflation, which components of inflation were particularly subject to it. So by going very disaggregated, you can actually understand versus seeing a kind of a global change, where it comes from, and then adapt to it.
Yeah. I mean, I guess picking up on that point you mentioned around the explainability being really important to policymakers rather than, you know, the number has gone up, why? And having that, I guess, does that feed into a broader sense that we need to explain the uncertainty around this and also what we think is going on in what can be black boxes? Because I'm conscious of two central banks and a brand new, shiny, nowcast producing machine at UCL. I mean, how have you thought, Raffaella, about communicating, I guess, the uncertainty around the estimates that you're going to produce?
Yeah, so that was a big thing. Actually, this one started because I did the same when I was at the Fed. So I redid the forecasting model because I realized that, you know, constantly I had this very nice model. I didn't quite understand what it was doing, but I needed to constantly answer questions about, okay, why, what's different from 6 weeks ago? And so it was very important to decompose. And so I think what Michele was showing is something, it's actually very simple, because you want something quick to communicate, which is literally this decomposition of what is new. Is it news? Is it positive, really literally strength or weakness in this sector, in that? Is there some particular story that you can tell? So I think that goes a long way towards communicating changes. Now, adding uncertainty about it, I think I can say it because I don't represent any central bank. You know, the Bank of England was actually a pioneer in this. I remember I was a graduate student. I was studying the fund charts. So there was pioneering approach to communicating uncertainties. Safe to say that maybe didn't work that well. I was going to say,
if you want to get a debate going, talk about the Bank of England fan charts. Funnily enough, I think that's just prompted a question from Chris Giles, if we can get a noted fan of fan charts.
Martin Wales sitting there.
Thank you, Chris Giles from the Financial Times. Actually, it wasn't that prompted it. It was my thought of what happened to GDP now from the Atlanta Fed last year and Liberation Day, when it failed miserably, partly because there was a massive surge of imports before the tariffs came in, and then the massive drop away afterwards. So I just wanted to ask the panel a very direct question. In the news today, the UK government is suggesting putting some sort of price controls on supermarkets. How would your nowcasting models react to that?
Oh yeah, I had many.
I was going to say, is this covered in the first release of the UCL?
It's certainly not. We're much more aggregate than that. So, yeah, no. I mean, this is all about also conditional forecasting. That's another big topic. So at central banks, you always have to condition on certain paths. You know, you keep some certain things fixed, and those actually matter a lot. So you can certainly do a lot of that, but that's difficult to communicate also. You know, this kind of scenario analysis that Giulia was talking about. So we're not going there.
Giulia?
Yeah, this is such a difficult question to answer because I don't know what I can say, what I cannot say. But no, I'm joking. But I think those are two different things, right? So I mean, my job is just to do models that are robust and that are sort of right, and I can tell you what is the risk, what is the contribution, where is the data coming from. But then, you know, all of this is all very political, right? So if something happens today, and you know, we need to have an idea if this policy going rule, right? What's gonna mean? What will mean for CPI aggregated, CPI food, and so on. So I mean, we do all of that, right? But with different models, right? So we have different models for different reasons, and then we bring everything to the MPC, and then we wash our hands.
Michele?
I just wanted to, more in general, this is not happening in the euro area, so I guess I can take it a little bit more general. So there are situations like these ones where there are ad hoc interventions, strange political dynamics, and so on. And normally the way this works, at least in the euro system, is that we don't change the mechanical models. We're not going to tweak them. But we accept that there is going to be a discrepancy between the judgmental forecasts, so the projections, and these models, because we can explain them. So we will have some judgmental intervention into the projections, and we leave the model as they are, unless some of these policies become actually systematic, and then, of course, we need to change the models as well.
Stephen? Yeah. Just get a sense, Stephen and then Martin, and then we'll take these two together.
Thanks, everyone. So I think at the very beginning of the Q&A, we talked about models and data and to what extent they sort of interacted or complemented each other. But if I view nowcasting as in some sense a missing data problem, I wondered whether or not there exists, at least in principle, a data system that makes nowcasting unnecessary. So I'm thinking, for example, in some Latin American countries, they have a data infrastructure whereby there's a real-time data feed from every individual firm to pass their invoices to some financial regulator. And from those invoices, you get unit prices and units sold and some description of what was sold so you can control for the quality. So in these sort of, super data-rich environments, which we see being built, at least in some countries, is nowcasting replaced by just direct observation? And if so, is that an argument for building these data infrastructures more widely, for example, in the UK?
Great question. Martin, and then we'll...
I wanted to ask, Martin Wheel from King's, I wanted to ask what's really a question for Michele. Does judgmental adjustment add or reduce the quality of the add to or detract from the quality of the forecast?
Okay.
Can you identify circumstances in which it's a good idea to ask people who think they're good at judgment to get near your forecast, and when do you want? And can you identify circumstances when you want to keep them away?
Okay. Giulia, do you want to kick off on the first question?
Well, that will be my dream, actually, to actually have a very rich data. I don't think I will be scared of that. I will be very happy if the role of nowcasting is changing again, instead of, beating the timeline space, but actually in figure out underlying patterns in this very rich data environment. So I think that can be useful to answer different questions, right? We can go into more micro forecasting, micro nowcasting space. But I will not be scared, if the data infrastructure will increase in quality, I will be very happy. I don't know. What do you think? I don't think it will be the end of nowcasting. We will still need to have a way of answering questions and figure out narratives in the data that we need to find.
Raffaella, anything on that?
Yeah, absolutely. I think better data, more disaggregated data, I can't go wrong.
Yeah.
It's not going to make you redundant.
That's fine if it does. I'll do something else.
Michele, a very direct one from Martin there.
Yes, so actually Martin knows very well the procedure at ECB, because a few years ago I was reviewing our projection procedures. So let me answer personally. So I don't think that judgment systematically adds to the accuracy of the forecast. However, one thing that can be said is that there are new events, like the one we were discussing before, or some of the things that Giulia was mentioning, and the models have not yet caught up. We do not have yet the information to capture those events, and their judgment can be helpful. For example, when we started to have all of these fiscal policies to reduce the impact of the increase in global energy prices in the different countries in the euro area, all of these policies were very different. They were very granular. So it was extremely difficult to have models and data to assess those. And their judgment helped to capture the effect of these policies on prices. But then we caught up. Then we started to have more granular models, new models, and then we could actually new data also representing those policies, and then we could model them, and then judgment wasn't useful anymore. So in my view, there are times which are very clear when judgment can be helpful. I don't think that is systematically helpful. And by the way, something that should also be said, which comes from my research, I was very mystified when I arrived at DCB and I saw that there was judgment, because I thought that people were just using models. First time I saw judgment, I was kind of scared. So I started to assess judgment. And what I can tell you is that actually the projection of the euro system, and I think that Bank of England, the Fed, pretty much the same, are very similar to those that you would get from historical regularities, so from large time series models. They are not that different, so there is not that much judgment after all.
Can I add to that?
Yeah.
So based on my research with our common friend, Carlo Altavilla, so we looked into the role of judgment, and there's a role for judgment. We're evaluating the expert predictions. So let's just say they've come under a lot of scrutiny as well. So even experts, even professional forecasters get it wrong largely. But one thing where they get it right is when they incorporate forward-looking information, because all of these models are backward-looking, statistical regularities. But and we did an approach where we were anchoring these forecasts to survey predictions of interest rate, because in this age of central bank communication, there's a lot of forward-looking information that a model cannot capture, whereas agents react really quickly to announcements that are really about the path of monetary policy. And a model has a difficult time incorporating that, but you can reverse engineer by kind of anchoring your prediction to that.
We've probably got time for one last question. Was that? Yep, Sarah, just the gentleman there.
Hi, I am a PhD student from Lancaster University. I'm working on high-dimensional time series. I'm very interested in the topic of adaptive pooling, which might have a lot to do with factor models. You please explain in an intuitive principle how this adaptive pooling doesn't work. Thank you.
Much more simple. A weighted average. It's very non-sophisticated. But factor models are really underlying all of these models that we're talking about. And those are very high dimensional. So the factor models, there's always going to be a role for that. So I think it's a good topic to be researching. But what I'm doing is a weighted average at the end of the day.
I mean, perhaps one last quick question from me just to wrap this up. You're all now producers of nowcasts and forecasts. It tends not to be national statistical agencies that produce nowcasts and forecasts. They tend to leave it to central banks, finance ministries, treasuries. Do you think statistical agencies should produce nowcasts? And why aren't they typically doing that? Conscious of a room full of national statistics colleagues. Any thoughts or reflections? Do you think they should do it?
I mean, if they do, I just want to know how they do it, really. So I know what is the estimation error, really. But for sure they use models, right? For sure they use different type of models, different type of aggregation methods that we know, right, how they work, and we know how we can forecast those. But as I don't know, I tend to say maybe not, but maybe this is a nice question. I haven't thought about that. Maybe you guys have an answer.
I think they already do enough estimation to get the data, but actually, to be fairly honest, I think that they probably should, because there is a lot of know-how in how the data behave, how to create at least the past history, and that is actually a very important know-how that we do not have. So maybe in the central banks we have a lot of know-how on modeling. We don't understand as much of the data. So as Giulia says, maybe it would be nice that they do it and they explain to us how they do it, because I'm sure that they would complement the type of insight that we bring, which is going to be different, but maybe complementing and combining, we reduce the error.
Yeah, what I would love to see is actually not a nowcast of the UK economy, but very disaggregated, granular, regional data. And then we play with it. Then we can do the nowcast and aggregate and then play with different methods. But I think what Stephen was hinting at would be enormously valuable to really get regional disaggregated data.
Excellent. Okay, well, thank you, everyone, for the questions. Please join me in thanking an excellent panel for a really stimulating conversation.